Now, if we do that and look at the difference between the 10-year yield and the 2-year yield, we get this chart. Okay, this is now a little bit different, but it's the same thing. It's just a difference between the two. So you have the 10-year yield and you make minus the US 2-year yield, and this is what you come up with. This is the curve that we see here. And here at the bottom, we have a 0% line. This means the yields of the 10-year and the 2-year are equal. And if it's above that, this usually means that the 10-year yield is higher than the 2-year yield. And that should be in a normal functioning economy. It should be the case, because if you lend the government for 10 years instead of 2 years your money, then you would expect that you get a higher yield, a higher interest payment from the US government, because you lend it out for 10 years instead of 2 years, much longer duration. So this is the duration effect. And now what is interesting here is that we see there are multiple times in the history where this yield curve has been inverting. So everything here below basically zero, we have a so-called yield curve inversion. And if the economy functions normally, this should not happen, because, as I said, a 10-year yield should always be higher as a 2-year yield because of duration risk. It just makes sense. And if this is not the case, and if the yield curve is inverting, like here in 2007-8, and like in the dot-com bust, then problems might occur in the economy. So here in this instance of the dot-com bust, it went negative and then positive again. Here also in the mortgage crisis, US mortgage crisis, we also had a dip down in negative territory, yield curve inversion, and then it rallied up again. And we had also a recession. So in both cases there was huge implications for the economy. And also here in the 1980s we had some crashes. So here we see again the same picture now in the COVID crash, that we had a slight inversion and a rally up, and also this was right around the time when the COVID crash happened. Now here again we see the yield curve is starting to tighten and inverting. This means the financial conditions are tightening, and this is a little bit a danger signal. And we are now at almost 0%, not yet inverted, but very close to inverting. And instead of the 10-year, 2-year yield, you can also pick another ratio, and some of those curves have already been inverted. But this is now just a formality, so it will very likely invert now because it's so close to zero. Now, what does it mean if it inverts? Does it mean we get a recession, and does it mean we get a stock market crash? Because in the past it has led to significant corrections and also recessions in the real economy. And this is now actually quite likely, because the statistics, if you look at it, and if you look at even previous years, you see that there's a high probability actually now that we will get a recession. But the timing of and this usually coincides also with the stock market crash. But the timing of this is not 100% clear, because as you can see here, if the yield curve inverts in 2000, it can take maybe some time, maybe 10 months, 12 months, a year, till this curve goes up again. And usually then this is the time when also the asset prices like stock markets also are negatively affected. And the same thing happened here in 2006. The real crash actually was happening in the stock market, I think, in the middle of 2007 starting. So it was already at this point. So here you have 455 days. This is more than a year. So just looking at those two periods, and you can look at much more events in the history, then you can find out usually the stock market is not directly crashing when the yield curve inverts. This is an observation. And usually it comes with a lag of maybe 10 months, 12 months, something like that. But it can even be a little bit longer. So, the timing question is hard to answer, but it will likely come. Now the question is, what shall we do as investors, right? Because, a lot of people in the investment community are panicking or making some panic noise and saying, yield curve inversion, very bad. And as an investors, the question is, okay, shall we sell all of our stock and just stay in cash, or what should we do? Shall we go into the bond market? Shall we go into real estate? What else? Shall we go into gold?